Are yields in for a bounce, and what will it mean for risk markets? Welcome back to the Bitcoin Layer. I'm Nick Bhatia. In today's global macro update, we're going to take a trip around every asset class. We'll look at rates, we'll look at risk, we'll of course look at Bitcoin. We'll think about what's going on in financial conditions. And of course, we will take a look at liquidity. What is going on in liquidity broadly? We'll get into our model, talk about the individual components, and do a little bit of finance class. Let's start with US Treasuries. So I'm looking at the charts, and it's my estimate right now that yields are due for a little bit of a bounce. And I'm going to walk through why I believe that will occur and what the ramifications of it will be. Let's start with a chart of 2-year yields, one that's familiar to you guys. Two false waves of lower yields, one with the Silicon Valley, one in 2023 with a growth scare, but the real one coming this year with a breakdown below a long-term increasing trend in yields, and that's signaling the end of the hiking cycle, the beginning of cuts, and the beginning of a much more broad economic slowdown requiring the lowering of interest rates really across the curve, but mostly by markets themselves. Why do yields go down when inflation and growth expectations go down? Because investors are willing to lend money for less interest in order to lock in positive interest, because the alternative is investing in risk. And if you are investing in risk in a growth slowdown, you are putting your investment in jeopardy. So from the textbook, that's why yields go down when growth and inflation expectations go down. Looking at 10-year yields, similar story of the breakdown, a really long trend of, a long time of yields trending higher that ended this year. Yields have broken down, and below 4%, the Treasury market is showing us that there is a bullish impulse right now as investors are willing to put their money in Treasuries and lock in these 4% yields because they actually think they're going lower. One more look at the 10-year yield over a longer time horizon. So this is looking back a couple years. In purple, you have the yield, but in red and green, I have for you the inflation and real interest rate components to this Treasury yield. So 3.87 is the nominal yield. That's what you see when you see the 10-year Treasury yield today is at 3.87. That 3.87 is a sum of two numbers. One is the TIPS yield, so this is the real yield in green, 1.71, and 2.16, the inflation break-even. The inflation break-even is simply a subtraction equation, the nominal yield minus the real yield. The reason it's a subtraction equation is because the nominal yield, in purple, is a traded instrument. The green yield, TIPS, is a traded instrument. So both of these purple and green instruments have market observable yields. The red line is the difference between those two market yields. So it's a break even. So that's why you hear people call it inflation break evens. It's just the number that breaks even between these two. But the reason that we plot all three is so that you can see when yields are going up or down, what is causing that increase. If it's inflation expectations, the red line would be chopping around, but you can see that over the last couple years, even though we had a wave of up to 9% inflation, the expectation on a 10-year basis was muted. It wasn't really much above 2.5%. And so with the increase and decrease in yields, it's really all due to the real yield component. And that real yield component goes up and down based off of growth expectations. And so growth expectations are coming down right now, and that's evidenced by real yields coming down. The Bitcoin Layer is proud to be sponsored by Unchained, the leader in Bitcoin financial services. Unchained empowers you to take full control of your Bitcoin with collaborative multi-sig vaults where you hold 2 of 3 keys and benefit from a Bitcoin security partner. This is a really important feature. You can purchase Bitcoin directly into your cold storage with Unchained's trading desk and completely eliminate your exchange risks. Unchained also offers the best IRA product in the industry. You can convert easily your 401k or IRA into Bitcoin while keeping control of your keys. Don't pay more in taxes than you have to. Go talk to them today, unchained.com/TBL, and make sure you use code TBL for $99 off when you create an account. Now let's zoom in a little bit. So we're looking here at a 6-month chart of Treasury yields in the 10-year part of the curve. And I've shown you a little bit of an increasing trend line. It's modest, it's shallow, and it's also only connecting a couple points here. But the point here is to show you that actually that first spike down, it was much lower on the candle. The intraday was at 3 2/3 yield, so 3.67 more or less. And the bounce that we had a couple days ago, a couple trading sessions ago, was off of 3.77. So what I'm seeing here is a little bit of a higher low in yield, and yields dramatically came down. Now they're probably going to have to consolidate. So it is now my expectation off of this 3 2/3 level that yields will trade higher, potentially to 4%. And in this little wave higher, it's going to affect the rest of financial markets. Let's break that down. The first thing we have to think about if yields are going to bounce is that the dollar is going to bounce. And remember that a strong dollar is a tight financial condition on the world. A strong dollar is something that risk markets generally don't like. Now, if all asset classes had a correlation of 1, our job would be easy, but that's not the way it works. Correlations roll up and down through time, and sometimes they're stronger within certain asset classes or weaker. So our job is to understand these relationships and convey to you what is going on within markets and correlations and what that means for Bitcoin and risk markets. So what you see here is that the dollar and Treasury yields have a strong relationship because on a net basis, what happens when yields go higher, it attracts capital into the dollar because now yields are higher. So I want to send money out of a currency into the dollar to capture those yields. So that's why on a net basis, this is a relationship that really holds true. When the dollar goes up, it's oftentimes because yields are going up. When the dollar goes up, it puts risk markets in a tough place. So it's my expectation that as yields bounce a little bit here, the dollar will bounce as well, and it might put liquidity more broadly in a little bit of a tough situation and threaten risk markets at the margin. So that's my going thesis here coming into the next few weeks. But more broadly, I think that a liquidity wave is coming and it will send Bitcoin higher. The timing is almost impossible to know, but you guys should be positioned for it. We've talked about preparing yourself for 6-figure Bitcoin. It's taking longer than some of you might expect or might have expected, but Bitcoin cannot march higher with a sour liquidity condition. Right now, liquidity has been a little bit threatened of late, so we'll go into the internals there and talk about why that's the case. Thinking about gold quickly, while we're on this idea of global FX and where the dollar is going, gold actually has had an incredible run this year as the dollar has broken down a little bit and the strong dollar worry has subsided. Now, some people think right now that gold is setting up for a run at $3,000 to $4,000 as the dollar breaks down, and we would be sympathetic to that view. But right now, with a little bit of a bounce in the dollar, we could see gold hit a little bit of a resistance, and in that way, we're able to constantly test our theses. Is a strong dollar bad for gold? Is a strong dollar right now going to happen with a little bit of higher yields? And how quickly does that reverse? Now, thinking about what could send yields higher, I tend to think that it's mostly a price thing. Yields came down from 4 1/3 to 3 2/3 quite quickly. Profit takers were there. And then the bulls were not ready to step in when yields got back up to 3.8, 3.9. They weren't really ready to step in and buy. They were ready to let the market digest and consolidate. So price drives my idea that yields will drift a little bit higher, spend some time consolidating before they turn lower. So now let's bring back the economy. We've been talking about price so far in this video, and yes, price is truth and it tends to dominate our approach when we're looking at what's going on in the world. I start with price, then I read what's actually happening on the tape. The reason that I do that is because if you don't pair the price with what's happening in the news might make you think that something is happening, but until you look at the price and the price's reaction to the news, you won't actually be able to make sense of it. Now, it's my habit, and it always has been, to start with the price and read the news. So I think yields are drifting higher. But what might happen on Friday, September 6th, when we get our next unemployment report? Let's say unemployment comes back down from 4.3% where it is to 4.2 or 4.1. That is going to trigger a headline that says, unemployment rate comes back down. The Fed might not have to cut as fast as they have earlier, otherwise indicated, or that the market thinks. And so yields have gone higher today off of less cut expectations. Now that might happen, and that's almost my base case at this point, but it doesn't mean that I'm actually guessing the employment rate will come in lower, or that I think the employment report itself is going to be strong. I have no idea what the data is going to be. I'm just looking at the price and looking for a narrative that could send yields a little bit higher, or keep them higher, or keep the bulls away. So let's think about what is happening in the charts and then what's happening in the news as separate things, and be very wary of any headlines that says yields went up because of this economic reading. That's often not actually the case. Sometimes it is. And so thankfully you have us at the Bitcoin Layer to guide you through that. Make sure that you're subscribed to our free research publication at thebitcoinlayer.com/subscribe. And professional investors that are looking for that edge, you guys can check out TBL Pro. Thinking about global rates coming down, they're coming down all around the world. We had a weak inflation reading in Europe this week, and the expectation for another rate cut at the ECB is now locked in for September. We see the purple line declining. That's another Canadian rate cut. The blue line declining. That's another Swiss rate cut that's coming. The red line declining is the Bank of England. They will be cutting once again. And of course, in orange, the Federal Reserve going for their first cut in September. Now, looking at the next chart, we might see cuts at every single meeting now. So 25 in September, 25 in November, 25 in December. That's what we're starting to think. But now let me bring back the unemployment reading that you're going to get on Friday, September 6th, and how I'm thinking about the data and what's going to happen in the markets. Now, we were telling you that the economy is slowing and the Fed is going to botch this. They're going to be too late to rate cuts. And that came to fruition. The Fed then had to admit that, yes, we are going to cut rates, but the market priced in a ton of rate cuts. So you see on this chart, 2% of cuts by mid-2025. That's a lot of rate cuts. So that's actually pricing in a recession. But the way that you have to think about it is that there's a cohort of investors that think we're going to get a massive recession, rate cuts all the way back down to 2 or 1%, a huge rally in treasuries sending market yields down to 2%. And those investors are in the market now. They, however, have only put on part of their position. And that's why you get this expectation. When they come in with the full recession bid, you can expect yields to scream lower. But what have we been talking about with the spot economy? The data isn't showing you that the recession has arrived yet. The consumer is still spending. The unemployment claims, they're increasing, but they're not going up to any crazy metric that warrants some big sell-off in risk assets because we're all of a sudden worried about the consumer going away. We are worried about the economy, the lagged effect of monetary policy, slowing housing sector due to 5% of rate hikes over the last few years, the commercial real estate sector being in an epic slowdown due to secular changes in the way that we take out office space, as well as high interest rates and really an oversupply in certain segments of that market. So there are a lot of threats to the economy, but the spot consumer is hanging in. And so when the spot consumer hangs in, it allows rates to stay elevated or to postpone that recession bid and yields absolutely collapsing all the way down to 2%. So it's my estimate that that type of move lower just can't happen unless the data mandates it. And guess what? The data isn't as bad as a 2% treasury yield might suggest. And so the data isn't actually as bad as would be labeled a recession. And so because of that, yields might pop and they might just stay where they are until that next round of data comes in that actually brings the recession bid in much stronger. So that's the way that I'm thinking about this little pop in yield. It might be challenging for liquidity. We'll talk about that shortly. Now, at the Bitcoin layer, one of the things that we're doing is we're building an index. It's a metric that we've called TBL Liquidity. It's inspired by Michael Howell's and Cross Border Capital's liquidity index. And what we've done is we've tried to build our own from scratch using our macro bond data. What we've done is we've aggregated global balance sheets both at the commercial banking and the central banking level. And then we've either amplified them or diminished them based off of where yields are and bond volatility is. So basically 3 inputs: the banking system, treasury yields, and treasury volatility. And with these 3 inputs, we're spitting out a metric that gives us an idea of where liquidity is more broadly. If you guys are interested in that type of quantitative analysis, do not miss Mean Median Mode, our Monday weekly quantitative report. And it's a risk report for Bitcoin and to show you what's going on in Bitcoin and what are the drivers for Bitcoin. Well, one of them is liquidity. So definitely check us out, thebitcoinlayer.com/subscribe if you are interested in that level of quantitative analysis. Now, with financial conditions, this chart that I have, financial conditions is another way to represent some of that bond volatility. When financial conditions are going lower, it means that they are easier. It means that the repo charges, the volatility, it's all lower. That means market makers are ready to make markets. They're ready to buy and sell, provide liquidity, a different type of liquidity here when I say market makers. When market makers provide liquidity, they're basically saying we will buy and sell from you right now at a fair price. When we are talking about TBL liquidity, we are talking about a force of nature from the financial system on financial markets. So financial conditions, you can see, they are just easy. They spiked in 2020 when repo rates blew out, when volatility blew out, when credit spreads blew out. But all of that is really muted right now, and there's not a lot of fear. And so in that way, there isn't this huge wave of risk fear that's coming into the market. We think that that is modestly supportive to Bitcoin, but again, that can change really quickly. Now, speaking of TBL liquidity and bank balance sheets and the size of bank balance sheets, one of the things that drives bank balance sheets higher is larger treasury deficits. So government deficits at the US government level. And you can see with each bar above the 0 line here, this is a month that goes and comes and goes when the Treasury issued more debt than matured. And that's when the debt grows. The total debt is now at about 36 trillion. And yes, we see several months where it's going up by 300 billion at a time. And so when we have a situation of perpetual deficits, it will be supportive to TBL liquidity because it will drive balance sheet sizes larger. Now, within TBL liquidity, I told you that we have yields and we also have bond volatility. So now look at just yields with just stocks. And what you see is this relationship. When yields, which are inverted on this chart, so higher yields here are actually lower on the chart. The reason that we do that is because when yields go up, bond prices go down. When bond prices go down, the size of the banking system actually goes down because what do they own? They own bonds. So when yields go up, bond prices go down. When bond prices go down, the system contracts. And when the system contracts, stocks go down. And so that's what you see. Yields up, stocks down. Yields down, bounces stocks. So what you saw over the last few years with this relationship, higher yields, lower stocks. And with the relief of lower yields, we have seen higher stocks this year. And that is a relationship that we want to watch. But it's not only yields that drive stocks. Again, otherwise it would be really easy. So it's other things also. This next chart, same time frame on stocks, but instead of yields, bond volatility. And it's also inverted. Why? Because if bond volatility goes up, that banking collateral is less able to be multiplied by the banks because the market makers are not ready to offer lending in the repo market. So this higher haircut concept, when volatility goes up in bonds, the bond holdings, regardless of what happens in the price, the bond holdings are less able to be multiplied by that holder. So bond volatility up, banking system contracts, stocks down. Bond volatility down, stocks up. And so that's the marginal move and what we expect just from volatility itself. But remember, we combine all of these metrics. Now I want to show you something very interesting. It's looking at the same time horizon, but just U.S. commercial banking assets, which remember is going to be influenced by that Treasury deficit number, the net issuance number. Remember that this also has nothing to do with the Fed. The Fed will not influence commercial banking assets directly. Indirectly, yes, and that's a can of worms. We won't get into all that today. But commercial banks themselves are adding assets two major ways. One, buying bills and getting the deposits that are spent into the economy by that deficit spending. That's one. And two, what is the other way commercial banks expand their balance sheet? They lend money. And that's bank printing money, not Fed printing. And so what's the relationship? Higher balance sheet, higher stocks. And the really interesting thing, in the dip in April, we saw stocks go down too. So that tells us that U.S. commercial banking assets, completely independent of what the Fed is doing, completely independent of what's going on around the world, is going to drive it. Now, is a lower yield going to send commercial banking assets higher? Of course it is, but a lot of the banking assets are loans, and so those are not marked to market on any interest rate basis. So this relationship is one to watch. Now, thinking about the Fed's balance sheet, I show you here that reserves have maintained basically a flat level for the past several years, even as the Fed has gone into QT and shrinking its balance sheet. Why is that? The repo allocation has shrunk. The Treasury general account hasn't made much of a dent since the whole debt ceiling crisis, and so the Fed is now up against the prospect of declining reserves because repo can't shrink, Treasury general account is not shrinking, so now the balance sheet shrinking will cause reserves to shrink. And the Fed is very worried about that. Remember, they want ample reserves, not scarce reserves. Lastly, we're going to look at the Bitcoin price. It is in no man's land after the breakdown below this trend line. We had a false breakdown. Well, we had a breakdown, then we had a false recovery, then the real breakdown in that early August spill. Now we have Bitcoin basically in this range between 50 and 70,000. It'll chop there until it doesn't. We will be watching TBL liquidity to show us when there might be a risk impulse that comes back, and it might not come until the conclusion of finding out how bad this economy is going to get. So make sure you stick with us, subscribe to the channel, rate and review if you are an audio person. We know a lot of you listen, you wish you had the charts, but if you don't have time to watch and you do have time to read, subscribe and you'll get the charts there. So make sure you catch us at thebitcoinlayer.com/subscribe for our research publication, and we'll catch you guys next time.